So wealth creation involves the use of money to generate more money for you, and there are a lot of investment vehicles that you can try to help you do that. However, there are some vehicles that are a lot simpler and a lot safer, while there are others that are riskier. While the idea of generating more wealth with little to no effort is very appealing to a lot of people, investing in something can still be very intimidating, especially if you are new to the investing world. So in this video, we're going to talk about some low-risk investments that are just perfect for beginner investors. But before we begin, if you're new to the channel, my name is Dredd and I post personal finance and dividend investing videos, and currently I am documenting my journey in paying off my student loans. So if you're interested in seeing how everything unfolds, or you just want to show your support to this channel, then definitely like this video, share this video, and also subscribe to the channel because it helps with the YouTube algorithm. It helps this channel be seen by a lot more people just like you and me. So with that out of the way, let's get back to the video. Now, one of the things that new investors think about is whether or not they're going to lose their money in the process, because let's be real here, any sort or any type of investment has some sort of risks associated with them. And as someone new to the investing world, the last thing that you want to happen to you is lose all your money. But before we dive into these low risk investments, first we need to talk about risk and how we will define low risk in this video. So what is risk? Risk in investing is basically the potential of your money or your investments to lose some of its value or all of its value. Risk is a very essential concept in investing, so you gotta take that into account whenever you're looking into something that you want to invest in. Although risk cannot be quantified perfectly or measured perfectly, risk is something that a lot of investors think about and kind of like take into account whenever they're looking into something to invest. Low risk investments aren't exactly safe investments because there is still a possibility that all of your investment or your money can still lose its value even if it is called low risk. So I think it is safe to assume that everything that we are going to talk about in here are relatively safe investments. So to simplify things for us, we will consider low-risk investments as investments that are relatively safe, can guarantee you the return of all, if not even just most of your principal, and can net you some return when the principal is back. So the first low-risk investment that you need to consider is a high-yield savings account. So by now, you should be tired of me or even mentioning high-yield savings account or HYSAs. While it isn't exactly an investment, the fact that you can put your money somewhere on an account and that it will grow passively because of interest, because of that, it basically gets into my list. HYSAs typically generate 5 to 10 times more than traditional savings accounts. While typical savings account earn like 0.01% in interest per year, HYSAs can get you around 0.20 or 0.35 or 0.60% to upwards of 2% or wherever you are, whatever type of bank that you are using per year in interest. So that's very big. So it's not a life-changing investment, but it is still definitely low risk. Now, the risk that I can only really think of is if the bank did not insure the money that you have put into that bank and then the next day they actually shut down. So whenever you're looking for HYSAs online, make sure that the money that you put into their banks are FDIC insured or some sort of insurance in case something actually bad happens. If you were to create an HYSA, make sure that you never consider this as a form of income because you can never really rely on this sort of investment because it really just grows very small. The only reason that you should be putting money in an HYSA is to make sure that your money or your emergency money is actually growing over time until the time that you actually use it. So some examples of high yield savings account in the United States is Ally Bank, Marcus by Goldman Sachs, Wealthfront, and VO Bank. And there are a lot of other HYSAs out there, especially online banks, and they offer very, very competitive rates. So I suggest that you look into those banks online and do your own research. Now, the second low-risk investment that you need to consider is certificate of deposits, or what a lot of people call CDs. Certificate of deposits or CDs are fixed income securities or time deposits that have a very specific term and a fixed interest rate. They're almost similar to HYSAs because you can grow your money over time without, putting any work into it with, earning with interest and all that stuff. But the only difference is its liquidity. So with CDs, your investments are locked in a specific amount of time or what they call term. And terms may vary depending on what type of CD you took. It could could be just a couple of months to a year and maybe even a couple more years. The interest rates of your CD can actually be affected by the amount that you've deposited and also the amount of time you've locked it in. So a drawback with CDs is that you cannot take out the money you deposited until the maturity date or when the term ends. Well, actually you can take it out, but if you do, you will receive an early withdrawal penalty, and your institution actually have that in place in case you decide to withdraw early. There in that early withdrawal policy or EWP, it will state what penalties you will incur if you decide to withdraw early. Penalties differ from each institution, however, the most common one is that you will be charged with a few months' interest you've earned on that CD. Another risk, as stated by investor.gov, is that whenever you invest in CDs or certificate of deposits, inflation will grow faster than your money and lower your real returns over time. Now, let me give you some sort of example here. Let me send you a screenshot right over here. So for example, if you invest $1,000 in a CD with a 12-month term, and according to BLS.gov, the reported annual inflation rate is 1.4%. So if you have a CD earning you 1%, at the end of the term, your investment will grow to $1,010. But if we adjust it for inflation, your investment's value is at $996.06. So that's a loss of buying power of around $3.94. Now, if you invest in a CD with 2% interest, at the end of the term, your investment will grow to $1,020. Adjusted for inflation, the value is at $1,005.92. So that translates to a gain in buying power of $5.92. Because CDs have a fixed rate, if inflation actually surpasses the interest you're earning, then that means that you are losing the value of your investment over time. At the end of the term, yes, you're actually going to make money, but that money doesn't have enough buying power compared to when you first invested the money. So go ahead and ask your bank what type of CDs they offer, because CDs have different types for them. You know, they have different terms, they have different interest rates, and maybe they even have like minimum deposits. So go ahead and ask your bank and see what actually works best for you. And a third low risk investment is government securities. Now, government securities are securities being offered and backed by a governmental body. In the United States, the most popular government securities out there is basically the ones offered by the US Treasury. These are treasury bills, treasury bonds, treasury notes, Treasury Inflation Protected Securities or TIPS, floating rate notes, and savings bonds. Now, according to Investopedia, government securities are debt instruments of a sovereign government. They sell these products to finance day-to-day governmental operations and provide funding for special infrastructure and military projects. By issuing debt, governments can avoid hiking taxes or cutting other areas of spending in the budget each time they need additional funds for a project. Investors consider government securities as very, very low risk and very safe because of one thing, and that is the issuer, the government. Now imagine if your government doesn't actually fulfill their promise of paying you back the money that you invested in them. That would really suck, right? But anyway, investments are returned in full when the maturity date arrives, and interest payments are paid throughout the term of the security, making it a very good and reliable source of income for investors. For example, treasury bills mature from a few days to 52 weeks, and you get paid the interest when the maturity date arrives. Treasury notes mature in 2, 3, 5, 7, or 10 years, and you are paid the interest every 6 months. Treasury bonds mature in 20 or 30 years, and you get paid the interest every 6 months as well. Now, TIPS or Treasury Inflation Protected Securities are basically securities that are adjusted whenever there are changes in the consumer price index, and they mature in 5, 10, or 30 years, and then they pay out every 6 months as well, the interest that you are earning from them. Now, I'm not gonna go over the last two, floating rate notes and savings bonds, because treasurydirect.gov actually has a list of all those things, and they will go into detail as to what those investment vehicles are, so you can go ahead and look at that. I'm gonna leave a link for all the resources that I had in my blog, so that you can just check it out and see all the links there in one place. And here we are on the fourth low risk investment that you need to consider, and that is money market funds. Now, what are money market funds? They're basically mutual funds that pull together different type of low risk investments such as CDs, debt securities, a repo or repurchase agreements, and treasury bills with short-term maturities. A lot of investors like this type of investment because it is very liquid, and then the returns are paid to investors in the form of dividends. Now, these funds aim to maintain a net value asset or NAV of $1 per share. Any excess to that amount or to that NAV is very good to investors as it is paid in dividends, while falling below that $1 maintaining balance is very bad. In the money market fund world, they call that breaking the buck. Now, it is very rare for a money market fund to actually break the buck, but it does happen. Since its history, there has only been 3 times since this thing has happened: in 1974, 1994, and then in 2008, the financial crash. Money market funds are offered by investment fund companies and brokers to investors who are looking for highly stable, very liquid, and short-term investments. However, there are still some cons to it being, not FDIC insured, and there is no capital appreciation for your investment, and then there is also this risk of the sensitivity of the money market fund to any changes in interest rates. So the best use of a money market fund is to hold cash only for a short duration and should never be considered for retirement. And also, if you are looking into money market funds, it is best to know about the recent money market reform. Now, I'm not gonna go over it, in detail, but Vanguard actually made a great summary about the reform, and I'm gonna show it to you right over here. So the most important element here, if you notice it, is the liquidity fees and the gates. Now, the SEC realized when the 2008 financial crash happened, the sell-off of a lot of the money market funds, or when that specific money market fund broke the buck happened, it actually influenced, maybe a small influence to the financial crash. So they've implemented this one, and I know it has taken a very long time for them to actually implement it, but it's a good thing they actually implement it now. And because of this liquidity fees and gates, now investors who are in money market funds are now limited to actually start selling their funds immediately. This is to prevent any sort of crash, and to prevent kind of this panic with fund managers, so that they can have ample time to respond to requests of investors. So anyway, Fidelity, Charles Schwab, Vanguard, and E-Trade actually offer different sorts of money market funds, and I know there might be a lot more out there, so I'm gonna let you do your own research and figure out what's best for you. And there you go, those are 4 low-risk investments that you need to consider if you are a beginner investor. Now, that's a very long one that I made. I don't know how long this video will be when I edit everything, but it took me a long time to actually do this. And please guys, do me a favor, because it took me a while to actually make this video, not just the filming and the editing part, but the research part as well. I've learned a ton of new things here, and as a favor, please like this video, share this video, and comment any of your questions, or maybe you can just compliment me, for doing all this stuff. Then yes, that would be very great. I will really appreciate that one. And that's pretty much it for the entire video. So if you have any questions, like I said, comment them down below, and like the video, share this video, comment, subscribe to the channel, hit that notification bell so that you get updated whenever I post new videos just like this one. I am also on Instagram at DailyDredd. Chat with me, follow me, I will follow you back. We can exchange ideas there. We can just chat if you just want to have somebody to chat to. So that's it, I'm done. Thank you so much for watching the video. I hope you have a wonderful day, and I will see you in the next video. Bye.